The psychology of investing. Mastering your mindset. 1. Why mindset matters. Success in investing isn't only about knowledge. It's about emotional control. Fear and greed are the two strongest forces that move markets and also lead to costly mistakes. 2. Common psychological traps. FOMO. Fear of missing out chasing hype or trends without research. Panic selling. Dumping investments during downturns instead of holding. Overconfidence. Thinking you can't lose after a streak of wins. Loss aversion. Focusing more on avoiding losses and seeking smart gains. 3. How to build a strong investor mindset. Stick to a plan. Create an investment strategy and commit to it. Set realistic expectations. Wealth building takes years, not weeks. Control emotions. Avoid making decisions based on short-term news or hype. Practice patience. Great investors think in decades, not days. 4. Tips for staying disciplined. Automate your investments, set and forget. Journal your decisions to track emotional patterns. Surround yourself with long-term thinkers, not gamblers. Remember, volatility is normal. Don't let it scare you away. White heavy checkmark key takeaway. Your mindset is your most powerful investing tool. With discipline, patience, and emotional control, you can avoid costly mistakes and stay focused on long-term success. Retirement planning through smart investing. 1. Why retirement planning matters. Retirement may feel far away, but the earlier you start, the easier it becomes. Investing for retirement ensures financial freedom when you stop working. 2. Key retirement accounts and tools. 401k/workplace plans. Employer-sponsored, often with matching contributions. IRA/Roth IRA. Individual retirement accounts with tax advantages. Pension plans. Less common today, but still powerful if available. Investment portfolios. Stocks, bonds, ETFs, and mutual funds tailored for long-term growth. 3. How much should you save? Rule of thumb. Aim to invest 10 to 15% of your income for retirement. Start with what you can. Consistency matters more than big one-time contributions. Factor in inflation. $1 today won't have the same value in 20 years. 4. Investment strategies for retirement. In your 20s to 30s, take more risks, focus on growth stocks, ETFs. In your 40s to 50s, balance growth and safety, mix of stocks and bonds. In your 60s plus, prioritize preservation and income bonds, dividend stocks. 5. Avoid these retirement mistakes. Waiting too long to start investing. Withdrawing early and paying penalties. Ignoring employer matching contributions, that's free money. Not adjusting investments as you age. White heavy checkmark key takeaway. Retirement planning is not just about saving. It's about investing smartly over time. The earlier you begin, the more your money works for you, ensuring a secure and stress-free future. Cultivating emotional intelligence for investment decisions. 1. Why emotional intelligence matters in investing. The stock market is not just numbers and charts. It's a reflection of human behavior, fear, and greed. Emotional intelligence helps investors stay calm during market volatility. Avoid impulsive decisions like panic selling. Maintain discipline to stick to long-term strategies. 2. The role of emotions in investing. Fear causes investors to sell too soon. Greed pushes investors to chase hot stocks or risky trades. Impatience leads to abandoning long-term strategies for short-term thrills. Overconfidence makes people ignore risks and bet too heavily on one idea. Having high EQ means recognizing these emotions in yourself before they control your decisions. 3. Core EQ skills every investor should develop. Self-awareness. Recognize when your decisions are driven by emotions, not logic. Self-regulation. Learn to pause before acting on fear or excitement. Empathy. Understand how broader market participants might react to news/events. Resilience. Bounce back after losses without letting them define your strategy. 4. Practical ways to build EQ in investing. Journal your decisions. Write down why you're buying or selling. Later, reflect on whether it was logical or emotional. Use cooling off rules. If you feel tempted to sell/slash by impulsively, wait 24 hours before acting. Meditation and mindfulness helps reduce stress and keep you present. Automate investments. Take emotions out by setting automatic contributions, dollar cost averaging. Set clear goals. When you focus on long-term goals, retirement, wealth growth, short-term market swings won't shake you as much. 5. Stories and examples. During the 2008 financial crisis, many investors sold in panic at the bottom. Those who kept calm and stayed invested saw massive returns in the following years. Warren Buffett often says, "Be fearful when others are greedy, and greedy when others are fearful." That's EQ in practice. A beginner investor might see a stock drop 10% in 1 week and panic sell. A high EQ investor views it as a potential buying opportunity if the fundamentals remain strong. 6. Key takeaway. Emotional intelligence won't make you smarter than the market, but it will make you smarter than your emotions, which is often the difference between success and failure in investing. The role of patience in building wealth. 1. Why patience is a superpower in investing. Investing is not about getting rich quick. It's about letting your money grow steadily over time. Patience allows compound interest to work its magic. Impatient investors often sell too soon or chase hot tips, missing the true rewards of long-term holding. 2. The psychology behind patience. Human nature wants instant results, but wealth creation requires delayed gratification. Think of investing like planting a tree. You water it, nurture it, and wait years for it to bear fruit. Patience separates investors from gamblers. 3. Patience in different investment strategies. Stocks. Holding quality companies for decades instead of trading daily. Bonds. Allowing them to mature to earn full interest. Real estate. Waiting for appreciation while collecting rental income. Index funds. Consistently investing, even when markets dip. 4. Practical ways to develop patience. Automate contributions. Set up recurring investments so you stay consistent. Limit portfolio checking. The more you watch daily fluctuations, the more tempted you'll be to act. Focus on goals, not noise. Keep your eyes on retirement, financial freedom, or wealth goals. Learn market history. Knowing that markets recover from every crash helps you trust the process. 5. Stories and examples. If you had invested $10,000 in the S&P 500 in 1990 and left it untouched, it would be worth over $100,000 plus today, despite crashes like 2000, 2008, and 2020. Warren Buffett's patience turned Berkshire Hathaway into a giant. He bought Coca-Cola stock in 1988 and still holds it today, making billions. On the other hand, impatient traders who bought and sold during panic lost fortunes. 6. Key takeaway. Patience is not passive. It's an active discipline. By waiting, you let time and compounding do the heavy lifting. Remember, time in the market beats time in the market. Backhand index pointing right skies tip for your YouTube video. You could use a visual story analogy, like showing a tree growing from a seed to a full-grown fruit tree, to keep viewers hooked while explaining patience in wealth building. Watch out for the next chapter.